I'm pleased to be joined by Agnies and Scotty from Stockperks and Nick and myself from Curation. This is the first episode of the Retail Investors Zone. I'd like to start with a statistic that we think everyone should be aware of. 38% of the US stock market is owned by retail investors. That's not in their pensions, that's not in their 401ks, that's not in ETFs, that is single stock direct ownership. So my opening question for all four of you really is, with 90% of corporate budgets being pointed and targeted at attracting institutions, do you think that shift's going to change?
Who do you want to talk first, Nirav?
Jump in.
Where do you get your source of data from that 38% of the market is owned by retail investors outside of 401ks?
Yeah, it's actually Goldman Sachs study that was published at the end of the year in 2025.
I think it's the biggest disconnect in history, all right? Institutions spend 12 billion a year trying to get corporates to invest. Retail investors are the same size, and I don't know whether it's 90 plays 10, but whatever the number is, they're pretty much the same size. That doesn't seem to be contentious. And therefore, if you strip out passive investing from the equation, if you're not engaging with retail investors, you're not talking to 50% of the net new marginal bars in North America. And in maybe other markets, the percentage is smaller, but it's going to be around 30 or 40%. So I think we've reached a stage where not having a strategy just simply isn't an option.
Would you agree with that, Agnies?
Oh, 100%. I also think historically it's been hard to engage with retail investors. There haven't been the tools, there hasn't been the ability to tell your story to millions of people. And I think lots of corporates are a little bit scared. How would I tell my story to millions of people all at once? We haven't had the ability to do it, and now we do. So the storytelling is back, and it should be easy to get it all out there to the market to tell your story. And also, I think it's not just that it's 38% is owned by retail investors, it's also the daily trading volumes, which is a quarter of the daily trading volumes, which is a huge amount. If you think about it, a quarter of the daily trading is retail investors. And yet no one's engaging them and no one's talking to them and no one's saying, hey, did you know that the products you use every day are actually publicly traded and you can own stock in that company? So I think there is such a huge disconnect between what companies do and what companies believe and what retail investors want.
Agnies, you touched on this earlier. You were former IRO at Microsoft and you were dealing with your retail investors back in the day, pre-social media, pre-easy communication. Why was it that you didn't engage with them? You touched on it in terms of the difficulty of it. And I think that's probably there's some shell shock or PTSD with a lot of IROs now in terms of what that was. Can you talk about a little bit what that experience was and why it was so hard?
There wasn't and there isn't a way to connect easily with retail investors. Companies don't know who their retail investors are. They don't know how much of their ownership is owned by retail investors. They can get a guess, but it could be 1%, it could be 20%, it could be 30%. They actually don't know. And there historically hasn't been an easy way for the CEO to say, hey, you know what? Let's tell our story to the 30% of retail base. Like, where do you start? That's the ability now that I think has changed with technology, that we can easily get the stories out there.
It's interesting because you were in that position at Microsoft. I think there's a couple of things that I would say is that firstly, to use an American football analogy, investor relations is defense, not offense, right? It is constantly, let's move from one traumatic event where I've got to organize this roadshow, I've got to organize the capital markets day, CEO's going here, CEO's going there. The CEO story might be different from the CFO story, might be different from the COO story. There's only one way you can tell a story perfectly every time at scale, and that's actually video. And so where I slightly not disagree, because I think what you're saying is that the ease with which you can do this now has become far greater. Let's be clear, YouTube was founded in 2005. It's 2026, yeah? And the messaging still isn't correct. There still isn't a strategy. There still isn't a budget. It still reports to an FD whose job, quite rightly, is to watch budgets. And until these companies would never dream of selling their products the way that they sell their equity story. You wouldn't say, I'm only going to go and sell my equity, I'm only going to go and sell my product to half the people in the world or half the potential market. You just wouldn't dream of it. It's astounding, really, that in this day and age. And by the way, some really good reasons for it in defense of the companies, opaque regulation, some myths that retail was short term. When I turn on CNBC every day and I hear about retail buying the dip, same way as institutions are buying dip. And I've known for a very long time that if a hedge fund thought it was a sell, they weren't long-term players on the institutional side of the coin either. So this myth about retail needs to be dispelled. Democratization of information, better intelligence, better access, all the things that all four of us believe in are coming to the boil now. And again, it's no longer an option, and the technology has made it really easy to funnel. In fact,
Nick,
if you turn on Elon Musk's earnings calls, like the one I listened to anyway, it was retail questions first, Wall Street second. Sorry, as usual, talking too much.
Yeah, and one of the interesting things that I hear speaking to corporates all day long is the misconception is that they think that by speaking to retail, their inboxes are going to be flooded with hundreds and hundreds of thousands of individuals. And I think that's a misconception because the technology is an unlock to be able to speak to retail at scale and not be overloaded by individuals one by one.
Radical solution. Have an earnings call
That's it.
for retail investors. Takes an hour.
Yeah.
In fact, actually, people like Palantir and whatever let other people lock into their earnings call. Takes an hour of your time, the same way it takes an hour of institutional time. Again, a complete fallacy.
Nick, I remember now what I was thinking about is that one of the big myths, especially when you think back 5-6 years ago, is that all retail investors are day traders. The whole meme stock explosion scared the shit out of IROs, right? They would just say, oh, I'm only opening myself up to day traders and getting on a roller coaster, and the chance that our stock is going to have this crazy sort of ebbs and flows and whiplash. The reality is we run surveys at Stockperks. We've got 300,000 users on our app. We run quarterly surveys. We regularly are asking market sentiment, how long are you investing, how often do you trade? We always are seeing that people are buying and holding. The vast majority of folks are investing for the long term. The most common answer for that question of how often do you trade is 2 to 3 times a year. That goes completely against, this is clickbait when you talk about meme stock traders, day traders. That's a lot more interesting from CNBC, CNBC's coverage is to say, oh, all the meme stock day traders are going crazy. It's a fraction of a percent of the retail investors in any given day.
I'd like to reference one of our partners called Winterflood, who are a market maker in the UK. They just today published a retail investor report from Q1. And one of the most interesting takeaways I had from reading that report this morning was actually they could track the retail investor inflows and outflows moved significantly, minute by minute, responding to White House posts on social media. I think the takeaway is not the retail investors are day trading. I think the takeaway is they're far more sophisticated than most players in the industry give them credit for. And they respond to very clear messaging at government level or corporate level. And actually, rather than being scared of it, I think that's a huge unlock.
Yeah. Look, again, I think this is an area where we all need to do more work, right? I prefer to call them non-institutional pools of liquidity. There is a day trading community that provides liquidity. They fulfill one role, but then so do market makers on the institutional side, right? There's a mirror image for everything. And so it's really simple, which is you have different categories of retail investors, like you have different categories of institutional investors. You have buy long term and hold. You have hedge funds, which are long short. You have shorter term strategies, longer term strategies. Different people are entitled to have different strategies. Don't tar the whole of retail because there are some day traders and a stock goes up, because I promise you, if there's good news in a stock, institutions will be buying it just as fast as retail will be. And I think classifying retail into different sections and non-institutional pools of liquidity may be something that all four of us want to investigate going forward. But as a whole, they don't look that much different to me strategy-wise than the institutional tranche.
I think that fear of meme stockness is actually the wrong response, right? That's all the more reason you should be in control of your narrative. If you let it get out of control and turn into a meme stock, that means you're not doing your job. You should be, because that means the chat boards are going bonkers and you don't even know what they're saying, versus you could be coming out, getting in front of that, or being part of that narrative versus hiding under your desk.
So the meme stock phenomena was just a big wake-up call. It was just like, we're here and collectively we have power and we're going to mess with you. I'm not even sure that was within a corporate control. And I'm not advocating meme stocks, but what I'm saying is what an advert for a community that if you can guide constructively and positively and engage with in a language that they understand, not this nonsensical language that Wall Street's created in order to cast intellectual superiority over the audience. I've been on Wall Street for 40 years and I read research reports and I'm still struggling to understand all the pseudonyms, all the flash words, all of the stuff that turns retail investors off. Why can't you write in plain English? And there are great companies that do this. If you look at communications from Next, probably the standout retailer in the UK, and you look at communications for the chairman, you could give it to your grandma or your mum. She could read it and understand what that company was about. Why people can't start to do that, I have no idea.
And it's funny you said that, because if you have a look at the retail buys and retail sales of the last month, the largest buys have been in companies that people are very familiar with, which means they know their story, they use them, their household brands, their household products, which goes back to those companies are very familiar. So if corporates want to attract retail investors, and they should because they've got the money they want to buy, they need to become familiar. They need a story that resonates. They need to simplify it down. So retail investors like, you know what? I know this company. I know what they do. I know their product. I use it. I love it. I want to buy it. So that's what's been happening. Like all the well-known brands, the household brands are the ones that retailers are really piling into because of familiarity with them.
Oh, I think of you guys a lot because I went to, a couple of clients.
We can give you two, mate.
Sponsoring major football teams, and they've got the name of the product there, but they don't have the name of the company, right? And so the marketing budgets are tens and 50, 100 million. The equity budget, the average equity budget for talking to investors is about $320,000 a year. Now, obviously, there are some that are substantially higher for mega caps, but if you take the 50,000 out, companies that are out there and average it out, you got about $320,000 spend. And you're spending 50 million marketing your product. Why not take 200, 300, 400 grand of that and use it to start to market your equity story with a similar creativity and enthusiasm?
I want to ask a really dumb question. And it is a bit of softball, but also, why would you invest in that? Why would you spend that money on that?
In a company that I see pouring money down the drain, you mean?
Yeah, like why would you invest in marketing your stock? I'm laying down the baseline here for the sound bites, but why would you invest in selling your equity story?
Why? Because post-Anthropic, post-SpaceX, post-ChatGPT coming to market with trillion-dollar valuations, if they think they've got a bad time now in terms of getting attention, investment for their stocks, just wait 6 months or a year. So we live in the answer to your question is we live in an attention-driven economy. These stocks are stories, and CEO after CEO, I've been sat in a room with 10 and they're like, how many of you think your share price is undervalued? Like all 10 put their hands up, regardless of what the price is. It's we don't get any attention. And the honest answer is you're not getting any attention because you don't assign any budget to it. You don't you don't have any creativity, and you don't deserve any attention because you're not trying, right? On the product side, you understand it really quite clearly. Another brilliant thing I think you guys are doing, it's like, why shouldn't BMW try to make shareholders out of the 50 million people that drive BMW? Why shouldn't BA, which is probably the most trafficked company in Europe, in terms of, certainly in Britain, in terms of internet exposure, try and give benefits to its shareholders in terms of lounge access, and to further encourage longer term ownership? And that's what we particularly love about Stockperks, which is why not create a foundational base that's more solid, and then also that you can market to because they're using your products or owning your shares already.
Yeah, I think we really get excited about the thought of let's make your consumers your shareholders and make your shareholders much better consumers. It's a win-win. You use the product anyway, you should become a shareholder in that company. If you're a shareholder in the company, you should become the biggest advocate for that company. You're an owner in it.
I couldn't agree more. I was actually thinking the other day, I haven't done it on ChatGPT yet, but it's almost like shareholder is the wrong word. It should almost be partner.
I think you're an owner. I think you should just be an owner. You're an owner in the company.
Yeah, partner owner. Yeah.
It's a massive unroll. Like I talk to my friends, right? And I ask them, what stocks do you own? And most of them own Apple. I said, why do you own Apple? What's your investment thesis? And their only answer is, I just love the products, so I bought the shares.
Yeah.
That's it.
Maybe the airlines shouldn't try and make owners of their shareholders.
I'll give you an airline.
Airlines shouldn't try.
No, especially American Airlines. Yeah, that's a good point. However, there was a big article in the Wall Street Journal this weekend about United and about how the new CEO had basically put all his chips in on loyalty. He just said, I'm going to make you fanatical about United in every different way. And of course, I'm a little biased, but I read through the whole thing saying, I don't see where shareholders fit into this. I've traveled United since it was Continental, which dates me a smidge, but I've got a fair bit of status there, and I travel a lot less, but I still pick up if I have to pick up the phone or I get to the guest, they say, Scott, thanks for being a million miler. Thanks for being a gold member. Thanks for being etc. I might not say gold member. That's a reference to Austin Powers. Now I think about it, but it's weird how that has that trigger. I'm going, oh, thanks. Yeah, I am. And imagine if you pick up the phone or you get to the gate and they say, Scott, thanks for being a shareholder. Here's an extra biscotti, or you get earlier boarding, etc. Apply that across everywhere you spend your time and day, going into Starbucks, going into wherever. But long story short, looking at that article, he's all in about loyalty and is missing this massive chunk of retail investors who aren't getting the same love as the consumers.
Build the same culture with your shareholders as you do your employees and your customers, right?
That's it.
And almost, I don't think it's either or. I think it's together. I don't think you should look at them as anything other than the same.
It's the one same team, one dream. That's my whole point.
Yeah.
I think, Nick, you hit the nail on the head. It's a new culture. And it's the culture of engaging your owners, your shareholders, your partners, whatever we want to call them, and actually making them actively part of the bigger kind of group that is an owner in a company, and providing them the support that they need to, and enabling them to become your invested ambassadors for the company that they own.
Yeah. Let me tell you a story.
It is a huge culture shift.
And it also answers Scott's earlier question. The reason that you have to do this is ultimately it lowers the cost of capital.
Yeah, simple answer. Yeah.
There's a kid that lives at the end of my drive. My wife, she's godmother, right? He lives in one of the cottages at the end of the drive, and he's one of the great kids of the world. And at 18, he used to work really hard in the pubs. He saved up £1,000, put £1,000 into Tesla 10 years ago. He got £35,000 now.
Yeah.
Go try tell him to sell Tesla.
Yeah, right.
Whatever any Wall Street analyst is saying, go and try and tell him that his grand that became 30 grand or 35 grand, right? He says to me, I am just never selling it, ever. And how does that precipitate itself? It precipitates itself in a $1 trillion market capitalization value, where if Elon Musk wants to raise 50 billion to do something, or if he has a bad set of numbers, everyone looks straight through it. Yeah. And that's the economic answer to your question from earlier, is that kid is never selling Tesla. And you see it in Palantir, and you see some star CEOs, right? And then I often say Spielberg doesn't put himself in his own movies, right? You can run a company quite brilliantly, but you can be terrible content. But no one's going to tell the CEO he's terrible content because they've all got their hands in his pocket.
Yeah.
So he's allowed to carry on being terrible.
Yep. One thing I was hoping for was the bow on the story. Does your neighbor's, the son, did he buy a Tesla?
No, I think he's.
That would have been the best. Would have made the story perfect.
He sees a car as a waste of time. I think he probably would see. I think he wants to funnel all of his money into the stock market, which brings me to another point. I don't know where AI goes. It's hard to read. But one of the things I feel more certain about is that there will always be new companies and they'll always require some form of capital. And in a world where we might be entering an employment crisis, for young people, I think investing becomes a life skill, right? So it's not like Jay had lots of money, he worked at the local pub, put 1,000, now he's got 35. What he does with the 35, it could become 100, which is exactly the sort of initiatives that Michael Dell is rolling out across America, which is that we're trying to get corporates to sponsor donations for newborn children so that by the time they're 21, they have a pot of money. And I don't know where we go with universal basic income, universal high income, but one of the things I feel more certain about is that investing is a life skill, and anyone thinks that this trend is going to diminish over the years is nuts. And anyone who's not addressing it really needs to take a serious, hard look at their communication strategy.
Yeah, Nick, I could not agree more. I think so many people are like, are retail investors still growing? Are they still investing? So India came up with a recent number, I think in the last week or two, about how many retail investors they have registered. And it's 130 million, which has increased by 10 million over the last 7 months. So it took them, the first 10 million took them years to get, then the last 10 million took them 7 months to get. So it keeps increasing. And it's not just US, UK, it is globally. Retail investors, there's more of them. They're becoming more aware. They're becoming more sophisticated. They're becoming more keen, and they really want to invest. I think there's one thing that we haven't discussed that's missing is education, which I would think we keep touching on it. But I think the next generation is so keen to get educated on how to invest, what to invest in, what does this mean, how do I become more active in it, and how do I get started? So retail investors are growing. They're here. They're not going away. Quarter of the daily trading volumes is retail investors. I think there's a missing part of it. Let's have companies engage these retail investors, create awareness of these more companies that they would never even think are publicly traded are actually publicly traded, and get retail investors excited about investing in them.
No, Nick, your point about investing as a life skill is awesome. I've got a 14 and a 16-year-old who basically every penny in goes straight out to buy some thrifted clothes or some Starbucks latte or something or other. They've finally both had big proper jobs this summer. They're both got investing accounts set up. I'm going to use that very simple soundbite. Investing is a life skill. AI is coming. You better start saving and making money in a way that's, I like it.
But also we have a duty to communicate with them in a way that excites and interests them. And not send them into a coma.
Right. Imagine trying to get our kids, Agnes, to try and read a bloody research report.
So this brings me to one of the things that I've been tracking, which is companies that are at the forefront of trying to engage retail and using tools to do it. So a story that hit my news tape this week that I thought was super interesting was Customers Bank in the US have done a partnership with OpenAI. And this week they have their quarterly earnings, and it took 30 minutes before the CEO actually said, by the way, analysts, by the way, participants, the person that's just been speaking for the last 30 minutes was my AI clone. Companies are starting to think about how they adopt technology. The more interesting example was last quarter. No one saw this, but Coinbase, on their quarterly earnings to retail investors, the CEO played a mobile game called Subway Surfers during the call. The reason why he did that, it's a TikTok trend. You talk about a topic, whilst you're talking about a topic, you play a really exciting game in the background, keeps people's attention. So to Nick's point, we live in an attention economy. It's more very difficult to use these kind of tools.
I've not heard of that one.
That's interesting.
There's a fine line between engagement and entertainment and attention and
gimmicks,
financial responsibility as well, which is a tightrope people will have to learn to walk. And that's, I hope, where we come in. Listen, a lot of these earnings calls, sometimes because it's in the US, it's quite late at night. I'm asleep before they've got through the IR and comms disclaimer. Yeah. So that can be 5 minutes.
Yeah.
Forward-looking statements and stuff like that. What on earth is that all about, right? It's completely unnecessary.
I think just the interesting thing is, especially in the UK, Scotty and Aggie, you can maybe talk to the US, but the UK's kind of changing really rapidly. So last year, I tracked regulation a lot. Last year, the FCA put in a 5-year plan to reduce red tape around investment advice and what you can say and how you speak to retail. But I think the interesting example, because it's sometimes really difficult to watch policy and regulation and what they say at the top level feed through into reality, right? What I thought was really interesting is last week, again, which is great, really positive news. The UK launched a retail investor campaign to turn our savers into investors. But for me, the most interesting takeaway, there wasn't one disclaimer on any of their adverts. No, your capital is at risk. No, this is not investment advice. And the reason is that is the red tape being reduced, actually coming into play. So I think things are changing a lot quicker than people expect.
I think there's a convergence of multiple themes, right? Which is clearer regulation, government directives to want to make capital go to work, an elevated appetite for risk, where people realize that there's cash in the balance sheet. It's just not gonna keep up with inflation. I think there's a whole collision of multiple trends that are all now moving in the right direction. What slightly contradicts what Agnies was saying earlier was that our shared vision of the future, we're not talking about the way the world should be in 10 years' time. We're talking about the way it's been for the last 10 years without people really grasping the nettle, right? And that's a pretty damning indictment on an industry that's supposed to be smart about asset gathering and capital. And also, I've run into certain asset managers and certain brokers, and the brokers basically go, yeah, we pitch retail, but we don't really do anything about it. And the asset managers saying the last thing we want is an educated retail audience, because we asset gather, and the better educated they are, the less likely they are to give their money to us. And there's some, let's be clear, in every industry, and Wall Street no more, there's some entrenched interest, which is very certain it wants to keep everything the same.
Yeah, well said. Well said. I am conscious of, we've hit half an hour, and we always tell people to be mindful of people's attention. So has anyone got any closing remarks or insights this week?
Yeah, the one that I came to the table with, and then I forgot about actually saying it, was or didn't get around to it, was that, so from our surveys that we've done, we just finished our Q1 survey. We focused a little bit more on loyalty. And so we were asking questions on that front. The key takeaway, I thought that this was awesome, is we asked the question of, if you are just a member of a loyalty program, how much do you compare shop? Do you look at all products that are not from a different company versus the company you're a loyalty member? And the answer, 13% said rarely or never. And then we asked the same question for a company that you're an investor in and a loyalty member. So you own shares in this company and you're a member of the loyalty program. How often do you compare shop? And the answer for rarely or never was 27%. So more than double. As soon as you become a shareholder and a loyalty member, it doubles the likelihood that you're going to buy only from that company. And I thought that was an amazing insight.
I think one of the things I love about what you're doing is actions speak louder than words, right? Which is that if you embrace shareholders, if you love shareholders, if you help them participate and feel a part of the company, they're far more likely to be loyal. So educating and engaging is one thing, and keep hanging on to them is another, right? Yeah. And I think that if people have been fickle in the past, it may well be that companies have done very little to actually treat them the way that they treat their employees and their customers. I think they've done it. By the way, I think they've done it exceptionally well in the institutional world. There's nothing that a large corporate won't do to engage a large shareholder, right? They just, I think, felt it impossible when they start to see the light, which is that now through modern technology, you can aggregate, you can make people feel special, you can give them stock perks, you can give them engaging content. I think we're standing in the middle of a mega trend, really, a mega disconnect.
Yeah.
I agree.
And have you noticed, like, all the recent IPOs, I'm so sorry, Nirav, all the recent IPOs that are taking place, they are allocating a much larger portion to retail investors than they historically have. They're no longer an afterthought. They are actively part in the IPO. Where historically it was like, we just care about the institutions, retail we don't really care about. Now here's a portion that's going directly to retail investors.
And Retail Book in the UK and Winterfloods in the UK are both trying to fight for the rights for retail investors to be able to participate pari passu with institutional investors on stock placings at discounts. And so there are multiple parts of this jigsaw puzzle which are inevitably going to roll up, I think, over the coming years. And we're very happy to be alongside you.
We'll be back on a bi-weekly basis, sharing our insights from the latest trends that are in the retail investor space and sharing some tips on how to unlock 38% of the US stock market that represents trillions of dollars of capital to support your companies.